What if I told you the next big financial disruptor is right under your feet? Yeah, we're talking about the possibility of a housing market crash in the US. Now, it's not just about interest rates or demand and supply. It's about something even bigger: political instability. Why should you care? Because politics and the housing market are more connected than you might think. With the policies shaping the very foundation of our economy, even a slight shift in political winds can send shockwaves through housing prices. Consider how changes in tax policies or infrastructure spending ripple through the industry, affecting everything from mortgage rates to construction costs. But what's really fascinating is the way recent political developments are turning up the pressure. We're talking partisan gridlocks and policy shifts that might just tip the market over the edge. As lawmakers debate budgets and negotiations stall, uncertainty looms, all while creating a cocktail of unpredictability. And here's the kicker: it's not just about predictions. There are real economic indicators we need to consider. So what are these signs we should watch out for? Let's dig deeper into the dynamics shaking up the housing market to its core. Now picture this: rising inflation paired with stagnant wages, and that's when things start to spiral. Inflation eats away at purchasing power, making it harder for families to keep up with housing costs. When people can't afford to buy, demand drops. And when demand drops, prices follow. A classic pre-crash scenario. And let's add another layer: regulatory policies. As administrations change, so do the regulations governing everything from zoning laws to credit availability. One minute, banks are tightening their lending standards, and the next, they're flooding the market with easy loans. Sound familiar? It's a sensitive balance that, if disrupted, could lead to a harmful cycle reminiscent of past housing crises. But wait, there's more to consider. Global events, like trade wars and sanctions, can play an unexpected role. They affect building materials, leading to costlier home construction. If the geopolitical climate turns rocky, those extra costs get passed down to the consumer, stretching budgets thinner and thinner. Now, imagine these factors, all tangled up in an intricate web, where one tug sends vibrations through the entire system. It's the perfect storm for potential market volatility. So, with the stakes this high, what should we really be watching out for? Stick around, and we'll uncover the economic clues that might just hint at what's coming next. All right, it's time to dig into those subtle but telling signs. Start with mortgage delinquencies. When more homeowners struggle to make payments, it's often a precursor to larger issues. You see, those missed payments can signal a lack of consumer confidence and financial strain, both of which are bad news for market stability. Then, let's look at inventory levels. A growing number of unsold homes can indicate cooling demand, which puts downward pressure on prices. It's like an economic barometer. When there are too many houses and not enough buyers, it doesn't take long for prices to start dropping. Construction permits are another clue. They tell us what developers expect in the future. If permits are declining, it signals caution in the market, perhaps hinting at anticipated economic slowdown or credit scarcity. But what about the credit market itself? Lending practices are crucial. Tightened lending can stifle buyers, reducing market liquidity, while too loose lending risks creating a bubble. We've been here before with subprime mortgages, and nobody wants a repeat of that. Lastly, look to the international scene. Foreign investors often look to U.S. real estate as a safe haven. If they start pulling back, that's a red flag for domestic economic confidence, and in turn, the health of the housing market. So, with all these indicators in mind, how does one navigate these turbulent waters? Let's uncover some strategies to stay ahead, safeguard investments, and dodge potential pitfalls. So now the question becomes, how do we protect ourselves and our finances in this precarious environment? Firstly, staying informed is your best defense. Markets move rapidly, and having up-to-date information means you can make smarter decisions. Subscribe to reliable economic news sources and pay attention to experts who track market trends rigorously. Next, diversify your investments. Real estate might be a solid asset, but don't put all your eggs in one basket. Stock portfolios, bonds, even digital currencies, each offers different risks and potential returns. Diversification can mitigate the impact of a downturn in any single sector. Meanwhile, let's think about homeownership. For those considering buying, it might be wise to focus on affordability. Calculate what you can comfortably afford without stretching your budget too thin. Stay clear of variable rate mortgages if interest rates might rise. You wouldn't want sudden hikes inflating your monthly payments. If you're already a homeowner, building an emergency fund can act as a financial cushion in case of unforeseen calamities. Saving 3 to 6 months of living expenses could be a lifesaver if things take a turn for the worse. But above all, consider consulting a financial advisor who can offer personalized strategies based on your financial situation. They can provide insights into adjusting your investments to weather any potential economic storm. In this unpredictable climate, remaining vigilant, informed, and flexible is key. So, are you prepared to face these economic waves head-on and steer towards a more secure future? Let's explore what steps to take next. All right, navigating a potential housing market crash might sound daunting, but remember, every challenge presents an opportunity. So, let's focus on the possibilities that exist even amid uncertainty. For potential real estate investors, downturns can mean bargains. Properties may become available at reduced prices, and with careful analysis, you could identify high-value opportunities. However, due diligence is crucial. Research neighborhoods, economic conditions, and future growth potential before making any commitments. Renting could also emerge as a viable strategy. With fewer people able to afford homes, rental demand may increase. As a property owner, this could mean stable income streams. Alternatively, as a tenant, renting could offer flexibility until the market stabilizes, allowing time to build credit and savings. Let's not forget about leveraging technology. Real estate apps and online platforms can provide vital insights and trends, helping you make data-driven decisions. Virtual tours and online evaluations have revolutionized how we evaluate properties, making it easier than ever to spot a winner from anywhere. Lastly, education is empowerment. Expanding your knowledge on finance and real estate can provide a competitive edge. Online courses, webinars, and podcasts are readily available resources to deepen your understanding of the market. So, whether you're in it for the long haul or testing the waters, embracing these proactive steps can guide you through uncertainty and position you for success in the ever-shifting landscape of the housing market. Ready to seize these opportunities and turn potential risks into strategic advantages? Let's dive into the proactive actions you can take right now. So, as we navigate these turbulent waters of the housing market, remember, being informed, strategic, and adaptable is your best bet. Stay ahead by constantly monitoring market trends, diversifying your investments, and exploring new opportunities that even tough times can present. If you found these insights helpful, make sure to subscribe and hit that notification bell to stay updated on future videos where we unravel more market mysteries. Share this with someone who might need these insights too. Ready to take control of your financial future? Let's make those waves work in your favor.